Hello and welcome. You tune into Rush Hour with me, Ankita Saxena. Well, the US government is preparing for shutdown after the Senate failed to pass a stopgap funding bill once again, leaving agencies bracing to suspend all but essential services. The standoff pits Democrats who want extended healthcare subsidies against the Republicans who demand a cleaner spending bill. President Donald Trump escalated tensions, threatening deep federal workforce cuts if the shutdown proceeds. What does this entail for U.S. economy and essential services? Well, to explain more, my colleague Sumita Karir is now joining us. Over to you, Sumita.
That's right. The U.S. government has shut down for the first time in over 6 years as millions are bracing for an uncertain future. This even as Democrats and Republicans are blaming each other for the impasse. Remember, this came after the Republican-controlled Senate failed to pass a last-minute government spending bill yesterday, which could have been averted. In fact, it could have averted the shutdown. And the shutdown, according to many analysts, that could reduce GDP growth of the country by 0.2 percentage points each week. That is, if it lasts. Now, how did the United States get here? Well, each year the US Congress draws up a spending legislation for most US government agencies, but it rarely finishes before the fiscal year starts on October 1. And in such a case, lawmakers pass a stopgap spending bill. This is essentially to avoid disruption while they finish their work. A few months back as well, such a shutdown was averted. But this time, the Democrats and Republicans are sparring over healthcare benefits. That includes subsidies for health insurance for low-income individuals should not expire, and reversing Trump administration's cuts to Medicaid. So what does this shutdown essentially mean? Well, under government shutdowns, federal employees are considered non-essential, which are considered non-essential are put on leave without pay. And this time as well, roughly 750,000 federal workers are expected to be furloughed. Many offices could be shuttered, even though Donald Trump states that we do not want the shutdown. Now, those which are considered as part of essential services that include Social Security, Medicare, nutrition assistance programs, air travel and immigration control, they will be required to continue to work, but they won't get paid until after the shutdown. Now, notably, this is not the first such shutdown in the United States. There have been a few shutdowns in the US's history, the longest one being in 2018 to 2019 under the Donald Trump administration. It lasted for 35 days. It is estimated that about 340,000 federal employees at that point in time were put on leave. The ongoing shutdown is likely to continue with the US President Trump's warning that it may go further, and that could threaten permanent layoffs.
All right, to weigh in more on the situation, we are now joined by Manpreet Gill, Chief Investment Officer, Africa, Middle East and Europe, who's now joining us. Hi, Manpreet. Thank you so much for taking the time out and joining us. Manpreet, this seems to be a prolonged shutdown. Previous shutdown was in 2018. That was for 34 odd days. This seems to be a prolonged closure, and this could have impact on the already slow economic growth, disrupt markets, and even erode the public confidence.
Hi, good evening. You're right. I think there's quite a bit of focus on the potential growth impact, even if that's small on a standalone basis, is coming against the context of a U.S. job market, which has been, visibly on the softer side, at least in the last couple of data releases. But I think the key point here, and I think the most important one for us is the length. I think that's the one you sort of started this point with. Because, look, we've had U.S. government shutdowns before, and they've always stemmed from some form of political disagreement. But how long that shutdown lasts is actually quite important, because we've had short-lived ones in the past, which have tended to have a fleeting or blink-and-you-miss-it impact as far as the financial markets are concerned. And we've had longer-lasting ones where we've seen a little bit more of an impact. So, look, the decision on how long the shutdown lasts, that's ultimately going to be a political one. But I think from a market perspective, I think we're quite focused on just how long the situation extends. I think that will really be key.
Point taken, Manpreet. Also, the U.S. markets, if you look at the U.S. markets there, it is sitting at record levels. We have also the looming, on the other hand, the looming tariff war, which will eventually lead to inflationary pressure and a weak labor market that's at hand. What are the ramifications of this shutdown on the U.S. economy?
Look, I wouldn't be excessively concerned about, downside risk from the shutdown alone. I acknowledge the risks, right? We've all been paying a lot of attention to the risk of slower growth, trade, that we're seeing in the labor market. But the reality is, despite all of that, equity markets have done continue to do extremely well. The risk, if at all, we think would be in the very short term. We've been flagging for a couple of months now that September, October tends to be seasonally weak months. Positioning is becoming, if anything, a little bit optimistic in pockets. So markets may be poised to look for an excuse to correct a little bit. But at the end of the day, while acknowledging that macro data, let's not forget that earnings growth for US equities as a whole has actually been very, very strong, and you've seen earnings getting revised up quite significantly. So at the end of the day, unless something really derails that earnings picture, markets are likely to soldier ahead. And really, if we do get a pullback driven by this, we'd expect it to be relatively short-lived, and if anything, an opportunity to rebuild exposure where investor might have been looking for a window to do so.
Right. Also, Manpreet, do tell us, in your opinion, this time round, what could be the timeline, or how are you penciling the shutdown to be bigger than the one in the late 2018 during Trump's first term as a president? Because back then, the Congress had passed some funding bills. This time round, there are people within Trump's party that have voted against the stopgap wage bill itself.
Well, it's always very difficult to try and sort of pin down a likely time, because to your point, right, this is ultimately a very political decision, and the decision to initiate a shutdown was political, and I guess the resolutions in past episodes have also been about achieving a bigger picture sort of deal. So I think the way I'd approach this is to say, look, rather than trying to figure out whether this ends up being a very short-lived or long-lived one, I think it just helps to prepare for a range of scenarios, because you're right, if you take a pure growth perspective alone, the incentive is very much to try and keep this relatively short-lived and avoid a broader impact on the economy, on individual spending and employment. But it makes us prepared for a variety of scenarios. In our view, the long-term scenario is still a constructive one. That's why we still think, from a portfolio perspective, we'd rather own risk, we'd rather own equities, rather own cyclical assets. But we would prepare for the possibility that volatility does rise in the short term if the shutdown gets extended. And I think the ways we'd address that is at a portfolio level. That is why we've been constructive and continue to be constructive on gold. We think that, of course, is perhaps one of the better hedges out there, even after the extent of gains we've seen so far. And we prepared that, look, if we get a bit of volatility, we get a bit of pullback, that's something we'd be prepared to buy from a longer term perspective.
Also, Manpreet, Donald Trump had already threatened deep federal workforce cuts. Should the shutdown prolong? What are we penciling in as far as that is concerned? Because the shutdown has already happened and it's likely to be longer than the 2018 one. Is there a threat for that to go through the threats that Trump has been threatening with?
Look, it's day one of the shutdown, so it's important to try and separate what may be, both sides sort of sticking out their bargaining positions. But, let's not forget the macroeconomic context here. We do have a US job market that is, very visibly on the softer side. So while it's not at recessionary levels, but it's not growing very, very strongly either. So, any impact on employment would be, a data point that markets would be quite sensitive to, and we think the broader economy would be quite sensitive to. Now, good news is that we have got the central bank starting to cut rates to sort of help balance that out. But I don't think these threats necessarily change the bigger picture that, public sort of statements aside, it's the length and nature of the shutdown, and the length in particular is the one which we sort of place the greatest weight on. And like I said, from an investor's perspective, we'd mentally prepare for a scenario where volatility temporarily rises. That's perhaps one of the more worst case scenarios out there. But at the end of the day, even those sort of positions, we don't see that altering the fundamental earnings backdrop. That's still been the biggest driver of the market rally so far. And that's why if we do get volatility, and that's something we'd rather be buyers rather than sellers of.
Okay, point taken, Manpreet. But, where does this shutdown really leave the confidence of US citizens and the world on the US government and leadership?
Well, I guess that's a question that's come up an awful lot this year. But look, I think it depends on the context in which sort of realm you're sort of discussing that point in. From a market perspective, it's still very hard to ignore the fact that the U.S. market is still overwhelmingly the largest one, relative to other major equity markets, and the U.S. currency like the dollar. We had the whole de-dollarization debate, but it's still front and center. Now, the way we've been addressing it is rather than sort of get caught into broad sweeping extremes one way or the other. We're ultimately saying, look, we can still sort of invest around this uncertainty of U.S. policy making, but in more incremental and what we call more market sensible ways. And I think two examples of that is, one is, look, all of this, potentially, we think the bigger implication of a lot of this policy uncertainty is on the US dollar. And we do expect a weak dollar for a variety of reasons, including very boring cyclical ones rather than, the dramatic sort of US policy sweeping ones. And, that's actually tends to be a good outcome for equities, and it tends to be a great outcome for non-US equity markets. We've been advising a lot of investors to consider non-US equities, as a great diversifier, where earnings growth is also strong. The second, of course, is to build in hedges like gold. And when you start to have questions like this, we think that has been and continues to be one of the big drivers of gold. It's demand from central banks around the world, and we think that story has further to run. So I think that debate over US policymaking will continue. Look, the reality is a shutdown by itself is not new, but we do think those two aspects, non-US equities, owning more gold, are great ways investors can build in some protection against those uncertainties.
Thank you so much for taking the time out and joining us and weighing in on the situation. And if you look at the U.S. markets or the Wall Street and how that has opened up, not much of a reaction, if you will, because U.S. markets seem to be trading pretty flat at this juncture. If you pull up a chart for Dow Jones, that's in the red. It is in the red right now, but it's absolutely flat. Just cuts off for 0.03% as of now. 12 points down take. S&P 500 is down 13 odd points. Nasdaq Composite is trading with cuts of 0.2%. So not much of a blowout that's come on the Wall Street, despite the news of a shutdown that's come in. Now, remember, the other piece of data point that's come out is that the data from processing the firm ADP has showed that private payrolls has fallen by 32,000 last month, well below the gain of 45,000 that economists were penciling in by Dow Jones. This reading, which signifies the biggest drop since March 2023, takes on even greater importance now that there is an economic data blackout because of the shutdown. So that's where the Wall Street is at, that's where the data sits at, and as of now, we are seeing very flat moves coming in on the Wall Street.